Hello, good morning. You're watching Market Cafe on ET now with me, Vinny Motiwala. Along with me is Ankita Saxena as well. Ankita, very good morning to you as well. And how are the market handle? What we're getting in from the US market? Anything exciting? Positive note? I believe this managed to close in the green, but how is it looking like otherwise?
Good morning to you, Vinny, and good morning, everyone. So yes, we did see a little buying coming in the US markets, at least, after sell-off that we saw a day prior. Now, the S&P 500 rose yesterday as traders combed through the latest batch of corporate earning results, searching for some clues on the health of the corporate America. Now, the S&P 500 rose 0.3%, while Dow Jones Industrial Average gained 100 points, and the Nasdaq Composite added 0.2% in trade. So largely positive in the green ending for the US markets. The European markets, however, closed mixed yesterday as investors looked ahead to the major earnings week that's going on Wall Street. That will shed some more light perhaps on the state of the US economy. The Pan-European Stock 600 index closed absolutely flat, erasing slight gains from the earlier in the session. DAX and CSE ended the day in the red, down 0.1% and 0.2% lower respectively, and FTSE was up 0.1%. And now remember, UK is also expecting its jobless claims and unemployment data that is due as of today, and we will be getting, of course, all the roundup tomorrow morning. That's the global handover that's coming in, Vinny.
Absolutely. And, on that global handover, we should also check out the crude prices, Ankita, because Brent crude oil prices, they are below that $85 per barrel mark this morning. Overnight, when you saw the session, it fell around almost 2% in trade as well. There was sharp pressure coming in there. What we're watching out for, we spoke yesterday as well, is the Chinese data, the China economic data that will be coming out today. So everyone's keeping an eye out on that. The recovery coming in China is a key factor that one is watching out for. Maybe in terms of the demand trends that would actually shape up from China, how is that actually seen, is a key factor to watch out for. So Brent crude oil prices somewhere below the $85 mark, around that $85 per barrel mark as of now, and WTI crude oil somewhere around the $80 per barrel mark as well as of now when you look at it. So let's keep an eye out on that, because yes, crude oil and Brent crude oil, WTI crude oil, both a bit under pressure. This morning opened up with a steady move, like what we saw in terms of the closing. But yes, still keeping an eye on the China economic data.
All right, then let's quickly go across to events that you need to keep an eye out on. We have globally, we have the China GDP numbers, the China industrial production numbers, and of course, like I mentioned, the UK jobless claim data that will be likely to come out today, and we will be tracking very closely. Also, we are in the thick of earnings season globally and as well. Globally, we have Goldman Sachs and Bank of America that will be coming out with its earnings as of today. And back in India, of course, we have ICICI Lombard and Tata Coffee coming out with its earnings. And in corporate actions, we have Bank of India that will be raising capital for FY24 of 6,500 crores. We have SBI that will be deciding on the long-term fundraising, and we have a board meeting of Jindal Stainless on the special interim dividend for FY23. And in the IPO action, we have Avalon Technologies that will be listing on the bourses as of today.
Absolutely, Ankita, but we have very exciting day, because for all those Apple iPhone lovers, Apple's own store in India are now a reality, and beyond the hype of what these stores are set to offer, the development must be seen in context of the shifting global supply chains and India's push for manufacturing as well. Tim Cook is highlighting 25 years of association with India. So then, what took Apple so long to open its first store here? What will Apple's presence here offer to India in terms of return, apart from, of course, what Apple says is better customer experience? Also, remember, many American firms have come to India earlier, with some succeeding while others exiting after disappointment. We spoke to Anant Dwivedi, technology and journalist, and Ray Wong, the principal analyst and founder at Constellation Research, to get better perspective on this. Let's go across and listen in.
Apple has been manufacturing in India since 2017. It's taken various initiatives with the app developers. There's a strong community of app developers in the country, long before the online store came in. And just goes on to show, I think what would be interesting was in the last 2-3 years, they've been launching devices at the same time as the international markets. And that has proved that India is a hungry market where devices are being picked up at the time of the launch.
This is a massively growing market, right? We saw revenues grow from 4 billion to 6 billion, right? That's a 50% increase. It's also from a population dynamic. India actually has the right population dynamics. China is actually going in the wrong direction. The US is flattening out. Europe is also in an inverted pyramid. And that means there's lots of opportunities to continue to grow in this marketplace. So India's hot, Indonesia hot, Brazil's hot. These are markets where you have an affluent middle class and one that actually values a luxury market and a high-end market in which the iPhone actually captures.
And all right, we will stay with the news for Apple. iPhone maker Apple, of course, launches Apple Card, the new high-yield savings account offering 4.15% interest rate. Now, the interest rate offered in this account will be more than 10 times the national average. And do remember, this new rate has also escalated competition amid rising interest rate cycles.
And shifting focus to some important comments coming in from the ECB President Christine Lagarde, citing anecdotal evidence of increased renminbi and rupee usage in cross-border trade. Lagarde flags off need to stop considering international currency status for granted. Let's take a look.
Financial services giant Ernst & Young, or as we know it as EY, has announced that it will cut as many as 3,000 jobs in the US, citing overcapacity in the firm. The said job cut impact 5% of its US workforce. The firm, in its announcement, has promised comprehensive support to those affected.
And Elon Musk's SpaceX, that was set to launch its towering Starship rocket for the first time from the private facility in Texas, called it off minutes before the launch. Now, the company announced a scrub postponing the launch for at least next 48 hours.
And US tech giant Alphabet shares took a hit on reports that South Korea's Samsung was looking to replace Google with Microsoft-owned Bing as its default search engine on the devices. The stock slid as much as 3.5% on the back of the New York Times report.
And in more broad-based news this morning, Morgan Stanley says that Asia's economic growth will outpace both US and Europe this year, largely led by the strong domestic demand. Now, the firm cites a rebound in China, not just post-reopening, but also sees firms' support from countries' policy and financial support. Among other economies, India, Indonesia and Japan are also showing a robust demand pickup.
And Japanese gaming giant SEGA has announced that it has made a $706 million offer for the maker of Angry Birds, Rovio Entertainment. The purpose of the acquisition aims to accelerate its growth in the global gaming market and increase its corporate value between SEGA's existing business and Rovio's strengths.
An update coming in on China and Taiwan. Taiwan is going to purchase as many as 400 land-launched Harpoon missiles in the wake of the rising threat from China, as per Bloomberg reports. Now, Pentagon announced $1.17 billion contract for the 400 anti-ship missiles on April 7th, and the production is expected to be completed by March 2029. Remember, Taiwan has previously purchased ship-launched version of Harpoon as a part of the military modernization effort.
Well, climate change has gripped the world, and this time it is the heat waves. 11 deaths were reported just yesterday in Maharashtra. West Bengal has shut schools for the week due to soaring temperatures. Earlier, my colleague Vikram Oza had explained what you can do to save yourself in the scorching heat and take care of yourselves. Let's take a look.
Officially, it's still just the month of April, but several parts of India are reeling under high temperatures. Only yesterday, 11 people have been reported dead. They died because of a heat stroke after attending a large public gathering in Navi Mumbai. 20 people have been admitted to hospital. 3 of them are critically ill. With weather forecasters now predicting the impact of El Nino and a harsher summer than usual, it is imperative that you prepare now to battle and protect yourself from heat strokes. But what exactly is a heat stroke? What are the kind of symptoms you can expect because of a heat stroke, and what should you do in order to protect yourself against it? Let's answer all of these one by one. Now, the Centers for Disease Control and Prevention defines heat stroke as a situation when the human body can no longer control its temperature. The body's temperature rises rapidly, the sweating mechanism fails, and the body is unable to cool down. And during this time, the body temperature can shoot up all the way to 106 degrees Fahrenheit. It can happen in only 10 to 15 minutes. So people who suffer from heat strokes, they experience symptoms of fatigue, of a headache. There could be dizziness, nausea, vomiting, low blood pressure as well, and increased heart rate. So as a matter of precaution, there are a couple of things that you can do to avoid a heat stroke. Firstly, you must stay hydrated. You must drink water as often as possible. Secondly, when venturing out into the sun, you need to ensure that you wear lightweight clothes and light-colored cotton clothes at that. When exposed to the scorching heat, you should use an umbrella or perhaps a hat to avoid direct exposure to the sun. And finally, you should avoid standing in the sun for a long time, and you should keep high-protein food at bay. Several parts of India, in fact, they are seeing daily temperatures much higher than normal. The Indian Meteorological Department, the IMD, has already issued a heat wave warning for several areas, and those areas include Punjab, Haryana, Chandigarh, Delhi, Bihar, West Bengal, Sikkim, Odisha, and also coastal Andhra Pradesh. Maximum temperatures are above normal by 3 to 5 degrees Celsius over many parts of the northwest, east, and northeast India. So with the mercury soaring, all eyes, of course, on the sky as we wait for the monsoon clouds. But until then, it's going to be a long, a rather scorching summer. So we need to prepare ourselves and drink up as much water as possible and stay away from the sun as much as we can.
Thank you so much for that explainer, Vikram. But on that note, we're going to slip into a very short break, viewers. Don't go anywhere. We'll be back with more updates on the domestic front after this break. Welcome back, and you're watching Market Cafe on ET. Now, let's just have a look at what the Asian markets are doing this morning, and we'll start with the Hang Seng as well as Shanghai. Both of them are trading in the red. Shanghai is down almost 0.2% in trade. Hang Seng, like you saw, okay, it's turned a bit positive, so flip-flopping between the red and the green over there, while Hang Seng is clearly down 0.7% in trade as well. Let's look at the Kospi, that is down almost 0.4% in trade. ASX 200 down 0.3% in trade as well. Nikkei is the one that is managing to trade on the positive side, comfortably standing in the green. So mixed opening is what we're seeing coming in from the Asian markets after the US markets have managed to close a bit in the green. China data is what everyone is watching out for. This is the first quarter data that they will be releasing in terms of the GDP data. Keep an eye out on that important factor. Other than that, SGX Nifty as of now indicating a muted start for the Indian market. 17,729 is what the SGX Nifty is at as of now. Welcome back, and you're watching Market Cafe on ET now, and let's talk about a time when ITC was the most meme stock, and now it's the most talked about stock, because look at the run up that we've seen coming in ITC in the last 1 year. Almost doubled in the last 1 year, crossed that 400 mark yesterday as well. It was at an all-time high, a lifetime high, a new high that the stock has come in as well. And let's just talk about some of the valuations of the company. We all know that ITC is much cheaper than other FMCG companies. Other than that, the stock has YTD basis also seen a very strong performance coming in as well, outperformed the other FMCG peers when you look at it in terms of YTD performance as well. Overall, the Nifty FMCG index in itself also has done quite well and much better than the benchmark indices as well. Key triggers that we talk about for ITC, they've managed to sustain in terms of a double-digit growth in their non-FMCG business. The cigarette business had started seeing a good recovery post-COVID as well. That growth has been resilient. We are expecting this time the company to report a set of numbers as well in terms of the cigarette business growth as well. And they've seen an accelerated growth in their hotels business, paperboard business as well. So hotel business is also seeing a very good and strong traction coming in as well. So that is a positive factor that could lead to a run up for the company as well. Soft major commodity prices, that softening of these commodity prices are a key positive factor for ITC as well. And taxes, when you look at it in terms of that, we have seen that the taxes have remained quite stable in the last few years, in terms of last 5 years, and maybe that is leading to the support for ITC as well, because when the taxes changes, that is when we start seeing ITC seek an impact of that as well. Taxes remaining stable, surely a positive sign coming in there as well, maybe, and that is also a curb on the illicit cigarettes. That is a factor that comes into play. Now, in terms of just some bit of a side, when you talk about risks, what could play in for ITC would be overall slowdown in terms of demand. Other than that, rural demand has still remained weak. So that is a concern, as well as government changes, like I was talking about taxes. If there's any change in that, that could be a factor that one should watch out for in terms of ITC's move and run up. But as of now, strong valuation that we're seeing coming in there. SOTP valuation, like you can see coming in on your screens as well. Cigarette business accounts for around 58% in terms of the total value when you count it in terms of the valuation of the business. FMCG is 26 times, and then other businesses come into play. So yes, interesting SOTP valuation, an interesting move when we see in especially the FMCG and cigarette business doing well. That means the valuations also look attractive for ITC as well.
All right, then let's focus on INDO accounts management meet. BNK Securities has listed out a slew of key takeaways. The management will focus on exports, especially the untapped markets. My colleague Lisa is here to tell us what were the key takeaways. Over to you, Lisa.
So, INDO account management has updated on the outlook in FY24. So what is saying that the FY23 utilization level, which was seen at 50%, that is expected to go up in FY24, though they have not provided any quantitative guidance on the same. Well, on the gross debt, they said that that is expected to reduce by 300 to 400 crore in FY24. FY24 earnings is also expected to gain from GHCL acquisition, which was done in FY23. As they said that sufficient land, the land is available for further expansion, as only 50% has been utilized. And their focus remains on the export market, as they see the China plus traction intensifying as other developing economies are facing challenges. And also they have recently started working with Marks and Spencer, as major UK retailers are looking to source from India. So that's the word coming in from INDO account management.
Thank you so much for that, Lisa. But let's move and shift gears and talk about CocaCola Thrive, Jubilant Food. Now, yes, we had spoken about this today. There was a news flow that came in, a news article that came in ET, which suggested that Coca-Cola was set to buy minority stake in Thrive. Now, let's not forget, just to give you all a highlight and precursor to that, in 2021, Jubilant Foodwork had purchased 35% stake in #loyalty. That's the company which actually operates Thrive. So yes, what came in as a Jubilant Foodworks disclosure that we saw coming in, that they highlighted that yes, Coca-Cola has purchased 15% stake now in #loyalty, and that is Jubilant Foodworks company which they have invested in 2021. So now post this will reduce their shareholding to 29.75% from previous 35%. There will be a dilution in their stake, and obviously #loyalty has raised capital from Coca-Cola. This is a round of raising capitals. A pre-money valuation of around 104.6 crores is what has come in. So let's keep an eye out on that. That's the latest update that we have that came in terms of a release on the BSE by Jubilant Foodwork.
Well, all right, then moving on to the IT sector. The IT sector was under pressure yesterday, mainly due to the disappointing fourth quarter earnings from Infosys. I mean, Infosys was down almost 10% in trade yesterday. And the brokerages also have downgraded their consensus on the stock. My colleague Anisha, who tracks the sector closely, is here to tell us all the details. Over to you, Anisha.
Well, yes, Infosys numbers have definitely spoiled the party for the IT sector, and we saw a negative reaction not only on Infosys but across the board. The mid-cap IT and the top-tier IT companies were coming under pressure, and you have it on your screen, the kind of downgrades that we have seen after the earnings, especially with respect to, at least 10 brokerages cutting their buy call and bringing it down to a neutral. The increased number of sell calls as well are up for you on the screen, 9 versus 4, which was there pre-earnings as well. And the, disappointment is both on the earnings as well as the multiples front. So if you look at the brokerage downgrades coming in, the EPS have been cut for FY24 and FY25 anywhere between 5 to 10%. But there is this, multiple cut as well, wherein from earlier when the stock was being valued at 23-25 times, they are now expecting that the stock will be valued at around 18-19 times. And that's the reason we have seen target price cuts of anywhere between 5 to as much 30% for Infosys come by. And we saw other, brokerage reactions as well. The Citi downgrade coming in for Tech Mahindra as well, and that stock took a slide because the street is now worried whether this is a one quarter, one company issue, or is it more structural in nature. And that's the kind of visibility we did not get from any management as of now. Infosys management also talked about a bit of a stabilization in March quarter, but they're not talking about the recovery timeline as yet. Even from Infosys, we heard about, deal cancellations, etc. happening, and that compares to delay that TCS was talking about. And even the exposure to discretionary spend as well as North America is higher for Infosys, and that's the reason we are sharper downgrades come in, because the street was very bullish on it. If you look at the TCS versus Infosys, kind of how it stacks up, the street was quite bullish on Infosys versus TCS, and that's why the reaction also was quite meaningful on Infosys versus TCS, and that seems to be a bit of a de-rating trigger for the entire sector.
Thank you so much for that, Anisha. And obviously, we spoke to a slew of analysts and experts to decode, the IT performance, Infosys performance, what's triggering the slide as well for IT companies. We spoke to likes of Girish Pai, Apurva Prasad, and Ravi Menon. Let's go cross and listen in.
You will get a modest positive return, but it may not be a great return. That's my view. So my own take is that Infi will probably have to come off by maybe like a 20% number for you to make, say, a teen kind of growth.
In terms of challenges, I would say maybe a Tech Mahindra because of higher, exposure to a communications vertical, and that is a vertical where both TCS and Infosys have cautioned. So purely from that standpoint, and because there is a transition which is happening at the leadership level, that could, show some kind of stress. We also expect some sequential decline in case of
This is a great opportunity with digital transformation. We see double-digit growth being possible over the next 3 to 5 years. This particular quarter, clients have taken a knee-jerk reaction, we think, because of heightened uncertainty that happened with the SVB collapse. And also in Europe, we've seen there were concerns that a large bank could fail. So with all that, people had just put a pause on CapEx, but we think that will return. It's just a matter of time. Maybe a few months later, we should see that come back. And structurally, we think we are on good growth trajectory.
Well, India's beauty and personal care segment is set to grow at almost $2 trillion, and the new e-commerce platforms like and SS Beauty have already taken a large share of the market. But the new entrant Tira by Reliance Retail seem to be challenging them. But how? My colleague Aishwarya Patel has more details on this. Over to you, Aishwarya.
A no makeup look, a stunning party makeover, or a skincare routine you can't refuse. Beauty and personal care brands are leveraging all this and more to get you hooked on to their products. And with the likes of Nykaa, SS Beauty and Sephora already competing for a piece of the pie in this space, with the launch of Tira, the competition is about to get tougher. While most multi-brand beauty and personal care stores give you a choice to pick from a range of products including skincare, cosmetics, perfumes and hair care products, Reliance Retail's Tira houses some unique experiences. A vending machine with samples to choose from, an option to give a personalized touch with the etching machine, although a bit gimmicky, and a fragrance finder based on the notes you pick. This machine gives you options of perfumes that you can choose from. While Tira's focus may be to enhance customer experience, there is still a long way to go before it finds its feet. And India's beauty and personal care space has room to grow to almost 2 trillion. Rival brands like Sephora, SS Beauty and Nykaa, although tight-lipped about their market share, have already built their network. Shoppers Stop has a network of over 90 stores across India, but apart from the shop-in-shops, it plans to add 10 to 15 Shoppers Stop beauty stores each year with a strong focus on exclusive distribution business. Sephora, on the other hand, has a network of 26 stores across India and has shown a low single-digit profitability in Q3 FY23. Recently listed Nykaa has a network of 135 stores across 56 cities in India. Experts believe for beauty brands in India there is more room to grow and opportunity to grab a bigger piece of the pie. But only time will tell which of them will be the showstopper.
Okay, thank you so much for that, Aishwarya. Surely time will tell which will be the showstopper over there. But on that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more stock-specific news.
Welcome back. Here watching Market Cafe, and it is that time of the show where we go stock specific and tell you all the stocks that you need to keep an eye out for in today's trading session. And for that, my colleague Lisa is joining us on more details on the stocks that you need to keep on your radar. Over to you, Lisa.
Yes, starting with the earnings, a mixed set of earnings was reported by the companies. Well, let's look at Just Dial. They reported good set of numbers on quarter-on-quarter basis. The revenue was seen up 5% and it stood at around 230 crore. Margin also saw an expansion at 14% versus 12% seen last quarter, and PAT saw an uptick of 11%. Moving on to Angel Set, they reported a muted set of numbers and they were largely in line with the analyst estimations. The revenue was seen up 10% and it stood at 826 crore. PAT was up 17%. However, the client base that surged up a whopping 50%, and they also recommended a final dividend of 4 rupees per share. On Quick Heal, they reported a weak set of numbers as the revenue was down 50% on year-on-year basis. They also saw an EBITDA loss of around 16 crore versus an EBITDA profit of 34 crore. And Naveen Sharma, who is the CFO of the company, he has resigned. And now moving on to the other corporate announcements, Godavari Power has updated that it is in the process of restoring the overburden dump of its Dongri iron ore mines. Remember that on 16 March, this dump had collapsed, and since then the company was facing issues in its volume. So, however, the company is expected to reach normal volumes by the end of this current month. Moving on to Kolti Patil developers, they have updated that they will be raising 206 crore via NCDs from Marubeni Corporation, which is a Japan-based company. And lastly, on Z, they had a block deal yesterday of around where they sold 4.91 crore by OFI Global China Fund at rupees 204.5. Well, the buyers' names are out, and the buyers' names include prominent names like Morgan Stanley, Goldman Sachs, and also Sejanti India, Mauritius. So, well, these are the stocks that will be on investors' radar for today.
Okay, Lisa, thank you so much for that. But let's move on and talk about some brokerages. And we have a brokerage note that is coming from Morgan Stanley on the affordable housing finances. What is the note actually indicating this morning? Where are they positive on? Let's go across to Harsh, who's read the report and is here with more details on that. Harsh, good morning. And what is Morgan Stanley saying on this affordable housing space?
Well, yes, very interesting report coming through. So what Morgan Stanley is actually alluding to is that the smaller housing finance companies currently are at a good benefit, and in terms of pricing also look quite attractive. And let me take you through each point in granularity. What they are suggesting, of course, is that there's no doubt with regard to the total addressable market. That's quite large in the affordable housing finance sector and will continue to remain large going forward as well. So they don't see a problem where that is concerned, but they believe that the smaller affordable housing finance players like an Aptus and a Home First have a differentiated and hence they have the key differentiator there is they have pricing power, especially in the smaller ticket size loans. This is largely ignored by banks is what Morgan Stanley says, and what they therefore believe is that the opportunity continues to be available for affordable housing finance companies. Also, the OPEX for some of these loans is quite large, and the ticket sizes is very, very small, and hence the larger banks tend to ignore these loans. That's what the underlying point that they're trying to make is. What they're also suggesting is that there's very little doubt with regard to asset quality, because some of these players have already been through COVID, and they've come out and they've emerged stronger despite COVID headwind. So they believe that the balance sheet has been tested, and that's obviously a positive, and that gives Morgan Stanley some amount of comfort. They therefore believe that the healthy loan growth, of course on a smaller base, as well as the EPS growth will continue to pick up, with ROEs remaining healthy going forward over the next 2 years or so for these affordable housing finance players. Within that basket, they prefer an Aptus and a Home First over an Aavas and a Canfin. They believe that the smaller balance sheet, of course, aids the former two players, and therefore they have an overweight rating on those and an equal weight rating on Canfin as well as Aavas. So therefore what they're suggesting is that Home First is what they've initiated, overweight, target price 900, and Aptus they've initiated with an overweight at a target price of 325.
All right, thank you for those details, Harsh. But moving on, we have all the brokerage notes coming in this morning, and for that we have my colleague Vamakshi joining us in the studio. Vamakshi, you've been scanning through all the brokerage notes this morning. Tell us what are the stocks that we need to keep on our radar?
Well, absolutely. Let's first start off with BHEL. We have a note that has come in from Antique, and they're highlighting that the company is expected to witness a meaningful reversal in its ordering cycle over the next 3 to 4 years. Vande Bharat train set order will propel BHEL's presence in the railway segment. Apart from that, the defense segment is also an emerging growth driver for the company. They're expecting an annual order intake of nearly 60,000 crores from FY23 to FY26. And on the back of all these factors, they've actually upgraded their rating on BHEL to buy from whole, and in fact they've also hiked their target price significantly from 54 earlier to 110, which in fact is the highest target price among all brokerages. Apart from that, we also have L&T on our radar. Jefferies believes that the investors are concerned about the pre-election impact both on L&T's order flow as well as its share price. Now, L&T's order flow rose by double digits over the last 3 pre-election year periods, and valuations, when we look at it on a historical basis, are definitely pointing towards a re-rating. So given all these factors, Jefferies has maintained a buy with a target price of 2,650 on L&T. And lastly, watch out for Indian hotels. Morgan Stanley has come out with a report, and what they're highlighting is that the company witnessed higher than expected room rates in the month of March. They're expecting better than expected growth to come in the Indian, that is the domestic subsidiaries, international subsidiaries and JVs. In fact, they're also expecting a turnaround in international subsidiaries from FY24 onwards. So given all these factors, Morgan Stanley has maintained its overweight rating on Indian hotels, and in fact hiked their target price from 378 earlier to 388.
Okay, Vamakshi, thank you so much for that. But let's go across and listen into Devina Mehra, Chairperson and Chief Investment Strategist at First Global, who believes that crude is actually slated to be the key talking point of the year. Let's listen in to her views coming in on this. What are the top sectors that could be affected as well?
What to my mind is the going to be the theme, at least for the Indian market, which will drive a lot of factors. And that is crude. So, compared to last year highs, we are down 30-35%. And if it sustains there, that is going to drive a lot of things in India. So if I look at RBI, for instance, they've paused on the interest rates, and my mind, they are waiting for that maybe crude will do the difficult part. So in India, that drives a lot of things. So, if crude remains down, it is not just crude. In fact, the part that you're never sure of is whether it will get passed on to the direct fuel, petrol, diesel, all of that. But it also drives a lot of downstream products. So if those prices come down, so that helps, of course, inflation control, because in earlier rounds, whatever inflation coming down we've seen in India has been driven by food, which can't go on forever. Only in this round, we saw some other factors change a bit. So inflation control, it therefore can drive demand. So as far as sectors are concerned, if input prices go down, that helps a lot of sectors. So it's like from FMCG to chemicals, textiles, paints, even large parts of the cement cost are linked to this. So there are a whole bunch of sectors where then companies can take a call that do we reduce prices and therefore get a demand boost, or we let the margins expand, or a combination of the two.
Well, that was Devina Mehra for you. And moving on, Mr. Anthony Capona, who's the president and CEO of Marriott International Inc., aims for a large share of Bonvoy members across the world. And the company aims to have at least 250 hotels in India by 2025. Listen in to this exclusive piece of conversation.
So as you point out, 2022 was a record performance year for Marriott. We posted record fees, record EBITDA, record EPS. And I would remind you that we achieved that performance in spite of the fact that January was very difficult last year because of the impact of the Omicron variant. And the China market was largely locked down for the bulk of the year. So we continue to expect increased performance into 23 and beyond. During the fourth quarter earnings call, we gave a bit of guidance, and we said we expect to see global RevPAR grow between 6 and 11% in 2023. Now that 500 basis points range is a little wider range than we've offered historically. And I think that the width of that range is appropriate given some of the economic headwinds and some of the economic uncertainty that's out there. But achieving something in that range would still be a powerful reflection of the continued recovery of travel.
So you mentioned that you have an exciting and a long runway of growth outside India. Tell us some more about it.
Of course, and I'll give you just a bit of context. If you look at the company's global portfolio at the end of 2022, in round numbers, we enjoy about a 16% market share in the US, our largest market. But outside the US, we only have between a 3 and 4% market share. So over the next several decades, the runway for growth, as you describe it, is very significant in terms of our international distribution. We continue to see strong, rapid growth across most of Asia Pacific. The Middle East is a terrific set of growth markets for us. We see big opportunity in Europe. And the Caribbean and Latin America is quite exciting for us. And as you've likely seen in some of our announcements, in the next month or two, we'll close on the acquisition of a large Mexican chain called City Express. And that acquisition will achieve a few objectives for the company. It will solidify our leadership position in the Caribbean and Latin America region, but it also signals our entry into the mid-scale segment. And that's a segment where we think we have growth opportunities, certainly in the CALA region, but potentially on a global basis as well.
On that note, we're absolutely out of time on this edition of Market Cafe. As of now, SGX Nifty indicating a muted start for the Indian markets. Don't go anywhere. The markets will take that.